Topic examines interest rate risk and return in fixed income investing. Interest rate risk refers to the sensitivity of bond prices and investment returns to changes in market interest rates. Because fixed income securities promise contractual cash flows, fluctuations in prevailing rates directly affect the present value of those payments and therefore the bond's market price. Understanding the relationship between interest rates and bond returns is fundamental for investors, portfolio managers, and analysts. This topic explains the sources of bond returns, the role of reinvestment assumptions, and the importance of duration in measuring the impact of interest rate changes on fixed income investments and portfolio performance. The program identifies three primary sources of return from investing in fixed-rate bonds. The first source is coupon and principal payments received according to the bond's contractual terms. The second source is interest earned from reinvesting coupon payments over the investor's holding period. The third source is any capital gain or loss realized if the bond is sold before maturity. Together, these components determine the investor's total return over the holding period. Analysts assume that coupon and principal payments are made on time and that reinvestment occurs at the prevailing yield to maturity. These assumptions simplify return analysis while illustrating how changing interest rates influence fixed income investment outcomes. Yield to maturity plays a central role in fixed income return analysis. If an investor purchases a fixed-rate bond and holds it until maturity while reinvesting coupon payments at the same yield, the annualized return earned will equal the bond's YTM at purchase. However, this outcome depends on stable interest rates throughout the holding period. When market rates change, reinvestment opportunities and market prices also change, causing realized returns to differ from the original YTM. Rising interest rates generally improve reinvestment income but reduce bond prices, while falling rates increase bond prices but lower reinvestment returns. This trade-off between price risk and reinvestment risk is fundamental to interest rate analysis. Interest rate risk primarily arises because bond prices and yields move inversely. When market interest rates increase, newly issued bonds offer higher coupons, making existing lower coupon bonds less attractive and causing their prices to decline. Conversely, when market rates fall, existing bonds with higher coupons become more valuable, leading to price increases. The magnitude of price changes depends on factors such as maturity, coupon rate, and yield level. Longer-term bonds and lower coupon bonds are generally more sensitive to interest rate movements because investors wait longer to receive a larger proportion of their cash flows, increasing exposure to changes in discount rates over time. The topic also introduces holding period return as a measure of realized investment performance over a specific time horizon. Holding period return incorporates coupon income, reinvestment income, and any capital gain or loss from changes in bond price during the holding period. Because interest rates may fluctuate before maturity, actual returns can vary significantly from initial expectations. Investors with shorter investment horizons are more exposed to price volatility, while longer horizons increase exposure to reinvestment risk. Therefore, the relationship between holding period return and interest rate movements depends on the investor's time horizon relative to the bond's maturity and duration characteristics. Macaulay duration is introduced as an important measure of a bond's interest rate sensitivity and weighted average time to receive cash flows. Duration reflects how long it takes, on average, for investors to recover the bond's price through coupon and principal payments. Bonds with longer durations experience greater price changes in response to shifts in interest rates. Duration depends on several factors, including maturity, coupon rate, and yield level. Longer maturities and lower coupons increase duration, while higher yields reduce it. Macaulay duration also helps investors estimate the approximate relationship between changes in yields and changes in bond prices within fixed income portfolios. An important concept discussed in the topic is the investment horizon and duration relationship. When an investor's holding period equals a bond's Macaulay duration, the effects of price risk and reinvestment risk offset one another. In this case, small changes in interest rates will have minimal impact on the investor's realized return. If the investment horizon is shorter than duration, price risk dominates because the investor is more concerned with bond value fluctuations before sale. Conversely, if the horizon exceeds duration, reinvestment risk becomes more important because future coupon reinvestment rates significantly influence overall return. This relationship is critical for immunization and liability-driven investment strategies. Topic ultimately demonstrates that interest rate risk and return are closely interconnected within fixed income investing. Bond returns depend not only on coupon income but also on reinvestment opportunities and price changes caused by fluctuating market rates. Duration analysis provides a powerful framework for measuring interest rate sensitivity and managing portfolio risk. Understanding the interaction among yield changes, holding periods, and reinvestment assumptions enables investors to evaluate fixed income securities more effectively and align portfolios with investment objectives. Mastery of these concepts is essential for constructing diversified bond portfolios, managing interest rate exposure, and making informed investment decisions in changing economic and financial environments.